Hello and welcome to another edition of Nucleus Investment Insights. This week we're going to be talking about the flood of excess capital. So a bit of a step back and a thought about what is actually available. How does the general market look in terms of valuations? How does it look in terms of where the capital is coming from, and how does that fit sort of versus the sweep of history and what we've seen sort of in the past and what does that mean we can expect sort of going forward from here? So I think there's a just a reminder again that everything you hear today is going to be general advice. None of it is personal advice. If you do want personal advice, feel free to jump on a call with one of our advisors and have a chat and see how this might apply to your situation. So I think that where I'm leading to from this, or the reason for this, is this idea that markets are expensive, and they've been expensive for some time though. That's the issue. Is that at what point do you are we going through a fundamental change in the way in which markets are being put together, and at what point do you decide that waiting for markets to reach the average valuation or below average valuation measured over whatever period of time, 50 years, 100 years, 20 years, at what point do you need to sort of look and say, okay, things have changed? Now, there are certainly some changes in terms of the way companies report. There are changes in terms of the way that capital structures are put together, particularly in terms of the way that we're price to book values is one that I've hammered on a few times here, but that's one where the accounting over the last sort of 20 or 30 years has changed dramatically. And so if we're talking about looking at a company or looking at all companies from sort of 50 years ago and comparing them to some sort of value as at today, you need to be quite careful about what you're using, because you're just simply not measuring the same values because accounting standards have changed. And then there's this thought as well, is that if there is a lot of capital out there, and we've spoken, Viktor Shvets in particular from Macquarie, is one that we're sort of quite partial to some of his analysis, talking about this idea that there's this flood of capital out there, and we've got central banks who are quite focused on making sure that this whole financialization, this flood of money that we've got sitting out there, doesn't end up with returns that are too negative, because if those returns that come through as too negative, then what can end up happening is that sort of then flows onto the economy. So it's sort of this reverse idea insofar that given the financialization, and what I mean by financialization is just more and more money sort of poured into financial markets, is that ends up being what's driving some of the consumption as well, and some of the global sort of economic, whether it's more capital expenditure and things like that. And so there's this circular reference of saying, well, if stock markets do fall in any dramatic way, will that then mean that people spend less money, and therefore companies make less profits, and therefore profits, stock markets should then be worth less again, and you get this downward spiral. And so have we been in sort of an upward spiral as well? So I'm just going to jump quickly to a couple of thoughts around that before we sort of get to the valuation side of that. And one of those is just this thought around debt and global debt. Now, these charts appear in lots of different formats, but this is an IMF one from last year, and just sort of showing that over time, over the last sort of 70 odd years, we've gone from 100% ish of GDP being in debt to sort of 250-ish%. A bit of a jump for COVID, which is probably more misleading than you might think in terms of that. So that was actually, a lot of that was that the GDP sort of element fell away quite sharply as well. So yes, there was a jump up in debt, but actually a lot of that debt hasn't reversed, particularly in absolute dollar terms. It's just that what we saw was the denominator of that equation fell quite rapidly and then bounced back quite rapidly. So that sort of was a lot of that. And so there's this idea that, well, where does this debt come from, and what does it do? And in a way, this is a bit of a measurement of this inequality we've spoken about, insofar as debt has two sides to it. For every person that's gone into debt, there's somebody on the other side who now has an asset of some sort, whether it's a loan or whatever it is, sitting on the other side of that transaction. And so debt sort of doesn't appear. It's not sort of. It's a zero-sum game in terms of that. For every winner, there's a loser. And so the thought behind this is saying, well, how much of this is a measure that there's lots of capital out there, and insofar as, when the more debt there is, then the more there must be people on the other side that holding that debt. And so that's sort of that one part showing, yes, there's certainly more capital from the debt side floating around, or considerably more. We're 2.5 times almost higher than what it was 70 years ago. And 70 years ago, we can go back further and do other things. The data gets a bit dicey the further back you go, but there's that, it wasn't far out of World War II, and so which was a very destructive event that needed a lot of debt for countries to go into to sort of to meet that. So and the other thing is, you've seen obviously you can see on this as well very much the rise of private debt as well. So this chart sort of showing the dark blue line in the middle is the household debt, and the blue is the non-financial corporate debt. So why non-financial? Well, the banks are you're sort of double counting if you're sort of using the banks as well. So so we've seen that sort of rise to 50%, the household side of it to rise sort of 50-odd% of GDP as well. So we've got a by lending more to households and letting households borrow more, you effectively open up this sort of more capital to the rest of the world. If you look at that on a broader financial assets, so this is sort of a line just sort of showing stocks, bonds, cash deposits, loans, private equity, and just sort of looking at what's the value of those assets. Now, I've picked the US here just because we've got better data and longer time series and all that type of stuff. But it's not dissimilar in a lot of countries around the world. But you can see here that it's gone from being sort of 300% of the all those assets sort of put together, 300% back in the 1950s to 600% now. So again, just that significant rise in terms of the amount. And I'd highlight as well that that pandemic blip again. This has all been divided by GDP. So part of that it looks higher. It looks like, oh yeah, we've been higher than this before. Well, that was because GDP was reduced over that time period. So certainly lots more capital around from that perspective, if you're sort of taking a broader view. If you jump back to stock markets, and so there's a sort of a Buffett ratio, which is looking at the value of the stock markets versus the value of GDP, and exactly the same story over there. Well, actually, you'd probably argue worse. This is sort of back to the 80s, so that's 6 times higher than what it was sort of from that perspective. So certainly, much higher from that rate. So I guess there's this. Where does this lead us to? So we're sort of looking at this market. We're saying, okay, so we've got, where did this capital come from? And if the idea that I think sounds quite reasonable to me is that one is over time countries and get wealthier, and the world gets wealthier, and there's more money that the world has to put into to future projects if they want. So it's this idea that when you're a very poor country, you try to feed yourself and clothe yourself and generate heat is that sort of first step. And then as you get more money comes in, you can start building more and sort of future projects, and you can do research and development, and you've got this excess capital sort of sitting there that can be reinvested into other sort of future projects. And I guess the sort of logical extension of that is, well, the more you get, the richer the countries get, the more you're going to see in terms of this excess capital, and so potentially the lower return you're going to see in that excess capital, but also the higher valuations. And so how do you get the lower return? Well, it's by stock markets being bid up to higher levels. So if in the past, and certainly over the past sort of 100 odd years or so, stock markets are sort of giving you somewhere in that sort of 7 to 9% returns, which is sort of like about a 5% real return. So a return above inflation. And so if that's been that's been the experience for the last X number of years, is that is that number going to come down over time? Because now there's just more capital sort of trying to chase these same the same number of opportunities. And if that's the case, is there how's that going to eventuate? Is that just because companies are going to make lower profits, or is it because valuation is going to get bid up to the levels where the returns are lower? And so it makes a big difference as to which you decide is going to be the outcome. Because if it's companies going to make lower profits, then that's an argument for saying, well, the stock markets are overvalued and I should just be avoiding them and not trying to invest. But if the argument is all this excess capital is going to go into increasing valuations, so that you might have been able to get a dividend yield or say a total dividend yield of dividends plus buybacks and other things like that of 5 or 6%, and as your return, and then what we're looking at is that's going to need to reduce to 4 or 5% or 3 or 4%. And how's that going to happen? Well, that's by the price is going to go up, so that the amount of the dividend is going to stay the same and the price is going to go up. And if that's the case, you want to be jumping in front of that and saying, well, I want to be investing because I want to get that uplift in valuations as that happens. And so yes, that's one sort of argument in terms of how we're getting to in terms of what this excess capital is doing and whether you should be investing in more equities. The other argument is around the inequality side of it. And so this is the argument is that, you've heard spouted often here, is that the greater level we have of inequality, then the more capital there is around. So if I give, if I have $1,000 to split between 1,000 people and I give everyone $1 each and they go out and spend that money. Whereas if I say I'm going to take $90 of that and give it to the richest person and then split the other $10 between everyone else, and everyone ends up with a few cents each. Yeah, they're probably getting out and spending that few cents, but the person who's ended up with the $90 isn't going to go out and spend it. They're going to sit and try and work out what can they do to invest that capital. And we're still seeing that signs of inequality are keep increasing in terms of that. So I'll get back to a little bit in terms of what that means just after this message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, so talking about this inequality idea and however you want to measure it, whether you want to measure it by wealth, whether you want to measure by income, it's you can sort of split some hairs sometimes to sort of as to what's going on in particular areas or particular countries, but by and large, we're seeing an increase in that inequality. Now, the idea that more tax cuts for corporations it tends to increase that idea of inequality. We saw during the pandemic, we had this big flip where people got sent, globally, people were sent checks, except within China. So we saw within most developed countries, there was some sort of support for people who were stuck at home, and they tended to be the poorest people, and whether it was a direct payment or it was job keepers or it was whatever it was, that something that was getting money to these people from the government. And we saw this burst of inflation, and we saw that whole part about when you give poorer people money, they do want to spend that money. And I'm not saying that's a bad thing. That's a good thing if you're trying to grow your profits as a company. You want to see a country. You do want to see that sort of you want to invest for the market you're in. So if you think there's going to be less inequality, then we want to be buying companies that are going to benefit from that greater consumption. Whereas if we think there's going to be more inequality, then it's more about trying to look for lower interest rates. It's looking for CapEx type projects. It's looking for some of the more utilities and REITs and things like that, where as the yields get lower, these things are going to get bid up in terms of prices. And so so where I'm coming to from that sort of capital point of view is saying that there's one part which is things are getting better, technology is getting better, therefore should that mean returns are going to be lower? The second part then is inequality. And if inequality is getting worse, then you're probably going to see valuations again bid up, and returns get lower. But there's this interim period where prices rise in order to get the yields down, and so an important measure for us is saying, well, what is genuinely going on there, and what do we think is going to happen? So if we look at valuations over a longer period of time, and again, I've just grabbed US valuations just because it's easy, lots of data there. Is that, so I'll probably focus on the blue line, which is the forward earnings. Not that it's better particularly than some of the historical ones, but I think I think what happens is you get a better feel for what the expectations are about normal numbers, because within the actual numbers, quite often they get distorted by, tax, for example, even things like tax cuts. When Trump put through some significant tax cuts for companies at the start of his term, that affected a lot of actual earnings as they were writing up and writing down the value of assets, and how that flows through into numbers. But anyway. So we look at that and we sort of see that, back in the 80s and 90s, you're sort of on a 10 to 14 times earnings was sort of pretty typical. We sort of only really just touched it back there. So then we had this run up into the tech boom where price to earnings ratios were 20 or above. We then had the whole aftermath of that tech boom, and even still in the aftermath, they were still in the sort of 15 to 20 times earnings before we finally went into the financial crisis, where they took that tumble back down to closer to 10, and then we haven't looked back since then. So there's certainly an upward trend in the last sort of 50 years within this, and the question is, is the new normal for these ratios? Should it be in the sort of should the new normal be in that sort of 15 to 20 times or 20 to 25 times, and is that just going to edge its way up in terms of getting returns down over time? And I guess with that in mind, if you're investing today, you're looking at earnings, you're well above that sort of 20 times, sort of probably 21 times earnings about on terms of future earnings. You're saying, well, is that just a price that's way too high and it's only ever going to revert? Or is that maybe a newer normal? And a lot of this does come back to earnings. So I'll sort of move on to the earnings in a minute. But there's there's two ways that these valuations can come down. One is that the price can stay still and the earnings grow, and you can get it down quite quickly in terms of that. And there is lots of earnings forecasts within markets at the moment. And then the other way is we can have price falls. And given the earnings growth profile at the moment that looks like it's coming through, if you bought, within a year, say, that number, if prices didn't move, that number is going to come down below to sort of 18 or 19 times if earnings come through the way they're looking like it at the moment. So there's sort of that two facets to that. Okay, so I might jump. I'm going to go through with the investment view on this, but let's just have another quick message, and then we'll talk about what does this mean for investments and your exposures to equities.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So yeah, look, my take more generally is that I do think there's an argument on the capital side, and I think AI in particular is going to increase that. I think there's going to be more money spent on the capital part of the equation, and that's going to mean that the people who have that capital and own that capital, without government intervention, are going to end up with more power, more money, and so we're going into a period where, as we go through these structural changes, it's without significant intervention by governments, which doesn't look like it's occurring at the moment, because that can change, but it certainly doesn't look like it's happening. Is the workers will generally end up with less power, and corporations will end up with more power, and so probably there's a greater amount of profits, and that sort of means more capital available, which then bids up the price of stocks to higher than sort of longer term expectations. So that's on one side. The other side, that it's sort of interspersed within that. So we've got that technological change, but then there's the sort of natural inequality movements, and we're still looking at, I think, a political environment where it is about it's less about sort of trying to spread money more around, and it's more about trying to get growth, trying to reward those who are out investing, and reward the entrepreneurial side. And then this is a pendulum that we swing between, where at some points, you don't have to go back that far in terms of some of these numbers in the 80s, and where tax rates were 70% plus, some of the personal tax rates on people earning the highest amounts. And that's certainly come down significantly, and corporations as well has come down from well over 50% taxes on corporations to we're talking 20% ish, and potential to go lower rather than higher, I guess, is the idea there. And so there isn't this switch towards inequality. So that probably means we're looking at a world that has this excess capital. And then at the same time, we've got central banks that seem to be that are there to sort of try to, well, certainly they seem to have taken upon one of their mandates is to make sure that capital is supported. Let's just put it that way. It's sort of not. I don't think it's as and it's not as insidious as I think as you can get from some of the conspiracy theorists, but there's certainly a circular argument around. There's a certain amount of capital. That capital needs to be, if that capital is getting good returns, then the people take that money and go out and spend more money, and that keeps the economy going. And so I do think that's a factor that central banks are working into the equation. And so what does that actually mean for investments? Well, it means that you probably do want to have more stocks than you might ordinarily want. Now, is today the right day? Exactly the right day? There's certainly some volatility going around, and in the run up to the election, quite possibly we might see some further weakness in the market. But we're certainly looking still at the moment to pick up those sort of buying on weakness, and the idea that over the next sort of 5 to 10 years, we probably want more equities than we would ordinarily have, with a view that, look, we could be going to those higher valuations, and keeping an eye on some of these key factors that we're looking at in terms of whether that capital does start to fade away. And I guess the other thing to note, with all this capital sloshing around, the danger we have, or the key danger that we're really looking for, is where that capital gets caught up and there's a bit of a rush for an exit within certain elements. And that was exactly what we said. That's exactly what we saw within the Silicon Valley Bank stuff that we saw last year. We saw in recent times. We had the Japanese market and this flip between markets going to the carry trade unwinding, and that sort of caused this dyspepsia, this sort of indigestion for the market. But central banks then step in and the capital floods are back on. We've seen that some hedge fund problems the prior year. Like it seems to be these events are they're well supported by central banks, and that's the sort of the idea that yes, you'll get these short-term episodes, but eventually or usually quite quickly we'll get these rebounds because of just this flood of capital sitting out there just trying to find investments. And so we're certainly on board with that view, and the idea then is that we probably want within our tactical portfolios to have more equities than you might have ordinarily, and more than and this idea that valuations are extremely important, and you want to buy better valuations rather than worse valuations, but we might be in the type of environment where we see rising average valuations for some time until we start to see a reversal of some of those trends. Anyway, it's just a relatively quick one today. So, just a quick reminder, you can grab this as a podcast. You can see it on YouTube. The podcasts are available on all the major platforms. We run at 12:30 every Friday. If you've got any questions that you want to just pop them into the chat, and look forward to seeing everyone next week for some more. Thanks.